Nearly 15 minutes past the hour. This is the Open on BNN Bloomberg. I'm John Ehrlichman. We were just talking about the Canadian jobs report. We'll get a jobs report in the U.S. tomorrow, even though we're heading into a holiday weekend. Ahead of that, we are seeing some weakness for the U.S. futures after U.S. jobless claims, that's a weekly figure, exceeded estimates, and that adds to the economic slowdown narrative. I want to get some perspective on that from Liz Miller. She's president of Summit Place Financial Advisors. It's a complicated time, Liz, because we just talked about a hotter than expected Canadian jobs report. Oh, what does that mean for higher interest rates? But then you've got this U.S. jobless claims figure telling us, oh, things are slowing down. We've got a reason to worry. So I guess worry is the word of the hour right now.
Yeah, it's worry, and as usual, it's uncertainty that leaves these markets directionless. Claims came in about 18,000 down from the prior week, 228, but that did exceed expectations, and more importantly, they really increased up and revised last week's number. So we are starting to see some cracks in that unemployment number in our employment situation. What's ironic is that our Federal Reserve Chairman Powell has been talking about this for months, saying we really need to see employment consistent with our efforts in inflation. So, okay, here's some data starting to show that it's going to be consistent. But of course, what that means is if Fed Chair Powell is successful, that crushes the U.S. economy. So it is a yin-yang here in that we're starting to see some weakness that could eventually lead to lower rates, but more certainly it says we are seeing some struggles in the U.S. economy.
So let's tie it back to stocks, because now that we are marching towards earnings season, that seems to be the fresh narrative that I'm hearing from people. Oh, wait till we see what these earnings look like. And obviously the fact that the S&P had a pretty good start to the year. I know it was mainly in the biggest of the big names, but earnings season will be something to key in on. Already this morning we were talking about Costco with some lackluster sales. How close are you going to be watching earnings season?
I think this is the most important earnings seasons of the year. So I think the focus is going to be intense, and I think it's going to define what the market does for the rest of the year in many ways. First quarter, what we heard in the first quarter of the year was the year end from 2022. We had lived through 2022. We knew what it was. But most importantly, we spent most of last year understanding that earnings this year are going to be anywhere from lackluster to bad. That's already been priced in. That's what we endured in the stock market last year. So it's not even the first quarter number, but there's just so much interest in what management is seeing and what they're going to share with us in the next, 2 weeks to 4 weeks as all of this unfolds. We're really looking for that anecdotal insight into what kind of trends each industry is seeing.
Do you, as an investor, like, let's stay within retail. You got companies like Walmart that, generally speaking, are well positioned for moments like this. As an investor, are you gravitating towards the companies that arguably have more day-to-day certainty in an uncertain environment?
Absolutely. And we started making that move last year, and Walmart is part of that. A year ago, we had that incredible surprise from Walmart where we saw inventories jump 40%, something we hadn't seen unless you go back to like the early 90s before just-in-time inventory really kicked in with computerized management. So it was a complete surprise. And we saw Walmart the first to talk about it and other big retailers to follow. Here we are a year later, and as you just mentioned, Costco struggling perhaps a little bit. But what we see is that a company like Walmart that saw it first has spent a year rationalizing. They're very well positioned. They've recently announced, they're investing capital for the future, which is what we want to see in a weak environment. They're looking at ways to continue to automate their whole supply chain, trading at about 25 times next year's earnings with a good yield. And all those things we say we look for in an environment like this: strong balance sheet, good cash flow. So absolutely, to us, a core holding and still a good buy at this price.
Well, we were showing that one-year chart for Walmart since those shortcomings, almost a year ago, and a steady trend higher. We were talking at the beginning of the hour about the fact that gold has been marching higher, notably since November, several $100s an ounce. Right now, we're basically within about $50 per ounce of the all-time high. You've got people like commodity strategist Mike McGlone at Bloomberg Intelligence who feel pretty confident that gold's going to march right through that all-time high. How do you think, about something like gold in a period like this?
So we always like to hold a little bit of gold for our clients as something that is usually, a little bit protective, a place a lot of people go in uncertainty. We're not trying to necessarily call the top price of gold. But if you look back over really since 2000, since gold has been so easily available in an exchange traded fund, it acts very differently. It hasn't been a particularly good hedge for inflation until very recently. Sometimes it's the place everyone goes when they're worried. Sometimes everyone goes to the US dollar. We saw that huge run up in the dollar, and now it's just collapsed. We're doing some rebalancing. We're taking profits in gold, not exiting it, but feeling like this is certainly a time to take some off the table. And we'll probably be putting that back into dollar now that it's come so low, and keep both of those positions as those flights to safety in uncertainty.
All right.